I'm Keith McCullough, and welcome back to The Pitch. For those of you that have never experienced The Pitch, it's going to be quite the experience. We have 6 analysts. They're going to go at it 10 minutes each. They're on the clock for 6 minutes, though, and then I get to ask some questions. Leading off, certainly one of the best pitchers we have, Brian McGough.
Well, I teased this morning on Twitter as I put it out there saying we were doing the pitch. I said, will McGough actually pitch along this morning? And then I see your early look, short cyclicals, and I'm like, man, that's probably a bad idea. Plus the fact that most of my longs are probably shorts right now, particularly where we are in the cycle right now. But my call this morning is short Lowe's.
Oh, good.
Which is the mother of all cyclicals. This is one, go right to page 5 here. This is a very macro unaware management team. So the company came out with commentary in September and then again in November talking about how people, because there's no housing turnover, people are just going to spend more on their existing home. People do spend more on their existing home when they stay there, but the magnitude of which you spend on your home when you're getting ready to sell it or when you go out and you buy a home is about 4x what it is when you stay at home. Mm-hmm. So they don't buy that. They're not factoring that into any of their forecasts, and I call BS on that one. If you go to the next slide here, it's funny. They picked this, and this is right out of Lowe's presentation. They picked 93 to 97. It's like they handpicked the one point over the past 30 years where home improvement actually held up relatively well in a rising rate environment. Let's face it, it's not the same kind of rising rate environment that we're in now. It's not the same macro quad 4. It's not the same mother of all bubbles. There's so much.
1993 to 1997, this is like the opposite of that. I mean, that was a mid-cycle slowdown during the internet bubble. I mean, and massive growth bubble. We're heading into the deepest quad 4 recession of our time.
But this is what they picked, and this is what they're anchoring people on.
That's
so,
amazing.
Of course, that's where forecasts go. And this next slide here I really like. So this is, we went in here, I say we, I mean Jeremy. He does exceptional work on this name, as he does on every name. He's a great teammate. We go through category by category the dollar share that Lowe's gained over the course of the pandemic from 2019 through 2021. We got to update this with 2022 data, but if you just go through it, appliances, $3 billion in incremental sales, flooring, $1 billion, kitchens and bath, $1.5 billion, lumber and building materials, $4.3 billion, lawn and garden, $2.6 billion. This is all just market share gain where they gouge the consumer on price. And we're going to see a mean reversion in this. Traffic numbers haven't looked good for Lowe's at all. They've been hinging all entirely on ticket and inflation, and they think inflation will be sticky. I think someone is going to crack, someone is going to break. Once a competitor breaks in retail, everyone follows suit, and I think Lowe's is going to be one of them. If you take it this next slide, slide 8 here, it shows a margin walk. I love these gross margin walks because you can actually see over time from 2019 where the company's gross margins have come from. And Home Depot only gained about 100 basis points in margin. It's a much better managed company by like a country mile. Lowe's had 300 basis points in gross margin lift because of costs and pricing. So lower costs on the merchandising margin line, squeezing vendors, and actually taking a price to the consumer. This is more of a discretionary retailer. If I were to compare Home Depot and Lowe's, it's kind of like Walmart and Target. Target being much more of a discretionary retailer. Lowe's is also much more discretionary as well, easier to gouge the consumer on price, but also much easier to give that back. You can see on the SG&A line, they also got 160 basis points in gross margin because of salary and wage leverage. Now that's going polar opposite. It's going in the completely different direction, which is going to be a very, very big headwind, I should say, for Lowe's. Next one, this is our data that we use for store visits, where we track this very religiously. Comps are actually very easy on store visits. They were down last year, and they're still down 10%. So this company is hinging on price. It's just getting all of its comp on price and ticket. And what happens is when there's housing turnover, people take about 2 years to actually make their improvements on their homes. So the housing turnover that we saw in 2001 and 2021 and 2022, we're just starting to lap over that now, and we're going to see price reversion, which I think is going to be flat out dangerous. So traffic is not good at Lowe's, and I think ticket is going to follow. If you look at Lowe's, this is out of their presentation as well. They thought they were being macro aware, but they're extraordinarily macro unaware. They came out with the all right, if the economy is ripping, we're going to put up a 2% comp. If it's like down a little bit, we'll put up a down 2, and our worst case is a down 4 comp. Jeremy's model, which that dude can model, he comes up with the worst case comp of down 12.
Wow.
So we're currently modeling in our forecast of down 7 to 8, and our estimates are way below the street, as I'll hit on in a minute. Numbers can and will come down here a lot. One thing I want to make abundantly clear is that as we come out of Quad 4, which is still many months away, this one is still going to keep on going. So the softness is going to persist here over the course of trend duration, 3, 6, 9 months, and over sort of a tail duration as well. We get into 1 and 2 years. People are going to be comfortable buying retail again at some point in time. I'll turn bullish at some time. You'll turn bullish at some point in time. This name is still just going to keep going down and grind lower. I think it'll be a source of funds, and that the stock will test new trough multiples again.
Wow, that's and you're out of clock, man. It just buzzed in my ear at least.
It buzzed in your ear. I just want to rest people on this final slide 11 here, just to show where we are relative to the street. So for next year, we're at $9. The street's at $15. If I'm right on that, and conservative on the multiple, this has got 40% downside. And mind you, that's not using our bear forecast. That's using our base case forecast of down 7 to 8% comps instead of down 12. So I'll shut up there.
Well, I love how you put it all together. I mean, first of all, just to give everyone, and I'll do it for everyone, trend on this stock, Brian, is $212 a share. So that means it's below trend. The stock currently at 190. Risk range is 181 to 197, so still plenty of downside. And most importantly, it's signaling lower lows. So when something breaks trend, pardon the pun, lower lows for lows, but this is the bear setup. I mean, I sent out a sell signal on it recently when it was up. Like you said, I mean, and there's only 1.4% short interest.
It's tiny.
I mean, the buy side loves these names, though. I mean, is that not correct? I mean, the hedge fund community.
Because
Depot and Lowe's, great companies.
They haven't cracked yet. The hedge
They're
fund
cracking.
The earnings haven't cracked yet.
Okay.
And they're waiting for the earnings crack, and that's like you're down, 20% day in the stock in a heartbeat.
Right, because these are cyclicals. Yep. We said today, sell cyclicals. It's like said never during this kind of a rate cycle would Home Depot or Lowe's not be cyclicals. Last question on this, we're still short Home Depot, correct?
We're short Home Depot. I'm short Lowe's first.
Yep.
Lowe's is first because it's got more margin downside. Still short Depot. It comped down 14 quarters in a row during the Great Recession. It just put up a negative 0.1 comp. And people are like, okay, we got it out of the way. Like, no, sorry, there's a lot more pain to come here. Numbers are going to be coming down and down and down at a time when we're going to see other parts of retail actually recover. So not good from a flow of funds standpoint.
No, not at all. It's widely held by long onlys as well. So thank you very much.
Thank you.
Appreciate it. TJ, do you have something that can comp down for 14 straight quarters coming up here?
No, I have a company that has comped down for many quarters through COVID, but is actually looking up, and that's Carnival.
Okay.
Carnival on the long side. We don't like the hotels, and I debated whether putting a hotel in there. I think we've done a number of the pitches on hotels. We still don't like them, but CCL, since it's fresh in our heads given yesterday. So CCL long, Carnival kind of reminds me of our DraftKings call, where it was a show me stock. Carnival's a show me stock. It was about path back to profit, or path to profitability for them, path back to profitability for Carnival, high short interest, Carnival reported yesterday we got everything we wanted from the earnings release and the conference call commentary yesterday, but the stock took a day to react. They beat the quarter for the first time in 3 years. It was the first quarter in 3 years where they actually had something to report because of COVID, and it was good. Forward commentary was as bullish as I've seen, and it jived, most importantly, with our pricing survey and the commentary we've heard from travel agents. Now, stock's up today 7%, but still a ton of near-term upside for a trade. And it's definitely a show-me stock, but I like that setup because they they provided guidance which was just uber conservative, and I think some people are realizing that a little bit today, and that's helping. But when you just run the math on it, they're just setting themselves up, and this is a good strategy, I think, given that the perception there. But they're setting themselves up for consistent quarterly beats, and Carnival's like the poor stepchild. A lot of that's due to pricing in their Carnival brands, which has lagged during wave season. Wave season's the period where most of the cruises get booked between Thanksgiving and March, and Carnival's been lagging the other two guys pretty substantially. However, that was a deliberate strategy to conservatively fill up the ships, make sure they get the ships filled up, or at least on their way to getting filled up. And then, if things are good, you raise prices through wave, which is happening. So the good news now is that their pricing is actually accelerating faster than the other guys. And what we've seen historically is that's a really good sign for the rest of the year when pricing accelerates through wave. And the fact that they're catching up, I don't think is reflected yet in the street estimates. Street still has ticket prices flat with 2019. So they're way too low. They're likely low on onboard spend. I actually think we're low on onboard spend, but we don't have as much visibility as we do on ticket prices, so we're going to stay conservative. So the guidance spooks some people, but the setup is really good. At the same time, even with the stock up, today it's generally way down. It's at the low end of its historical range, even though yield growth is accelerating. Usually in yield accelerating environments, these stocks trade at much higher multiples. We're seeing them trade, specifically Carnival trade at the low end of its historical range, even in a decelerating environment, which we are clearly not in for the cruise lines. So what are the near-term catalysts here? The sell side's going to do their monthly pricing surveys, and they're going to come out positive, we think, and they'll catch on that Carnival's actually narrowing the gap. There's upcoming management meetings with institutional investors. RCL and NCLH, their two biggest competitors, are reporting earnings in late April and early May. And I think the commentary is going to be positive, at least based on our forward-looking pricing survey and some other leisure type indicators. And then just addressing Quad 4. Look, none of my stocks do well in Quad 4, but at least the cruise lines and Carnival specifically are coming from a kind of a zero, they're going 0 to 100 really. So the recovery is just getting started there. And by comparison, if you look at the hotels, the resort hotels, their room rates are up 30 to 40%. So if Carnival just ekes out positive growth on their ticket pricing versus 2019, that stock's going higher, right? So there's a lot of market share to catch up. Just to get, I'm not saying they're going to get to 30, 40% pricing increases, but that gives you a runway to growth and certainly lends credibility to them, at least getting positive pricing growth. So if you look at our slides, I'll back up some of my commentary just with the slides. So slide 2 is just our thesis slide. And the only thing I'd point out here is, the enterprise value, they did a lot of dilution with equity raises. All the stuff was necessary. They actually did quite a good job of getting liquidity because they've had no cash flow for 3 years, but their enterprise value is down 15% pre-COVID. Yet you're going to see EBITDA at least 7% higher for 2024 than 2019 and 14% higher for 2025. So that shows you the valuation compression here. Next slide, I just wanted to address some of the pricing. You can see from the chart on the left, pay attention to the right 3 bars. You can see Carnival's lagging. So this is second half 23 pricing as far as we can see out per our survey, which is done weekly, by the way, versus monthly by the sell side. And you can see that Carnival has lagged, but that's cumulative during wave. Now, if you look at the chart on the right-hand side, you can see Carnival starting to really accelerate through wave season. Actually, for this, we're showing it when Carnival, since the beginning of the year, and you can see consistent growth for their some of their major brands like the Carnival brand and Costa over in Europe, and for the entire company. So pretty good pricing numbers here sequentially, which is what we're focused on. Next slide is just, I was talking about yields being, or pricing, ticket prices being higher than the street. So here's the composition of our ticket estimates for 2023. We're still showing ticket price down 3%, as you can see from one of the bars on the right, but the street has it down 6%. And the big difference is that same ship pricing. That's the big key, and that's where we're really in depth in our pricing survey, and we can get a pretty good estimate of what same ship pricing is trending, and it's up 3%. So overall, for the entire company, we see at least a 3% differential between us and the street, which translates into quite a bit of EBITDA. And you can see when we break down the quarters, I'm sorry, the annuals on the right, you can see we're pretty consistently above the street here for 23, 24. And 25, and that translates into EBITDA growth here on the chart on the left on slide 5. We're 9% higher for 2024 and 8% higher for 2025, and that's leading to significant free cash flow acceleration on the right-hand chart and deleveraging, which they have to do. And then on the last slide, you can see pretty conservative price objectives here, and it looks like we think the stock should be worth closer to $14 and could get there relatively quickly.
Interesting. All right. So setup here is, and this is a real interesting one. We talked about this on the call this morning. When something breaks trend but is barely below it, and then you have a catalyst, and now it's challenging getting back above it, TJ. So you have $9.76 is trend. It's at $9.31 right now. Range is $8.36 to $9.99. So it's right smack in the middle, where the top end of the range is actually above the trend. Now that's a good setup if you can make a higher low after being a stock that's been bombed out. Obviously, this stock came down from 32 for people who weren't paying attention in mid-2021. And now it's got, like you said, it's got, just on that question, it's got $11 billion in listed cap, but you said the enterprise value is down 15. Can you just review that real quickly one more time on how cheap it is on the new enterprise value against the cash flow?
Yeah, it's trading at like sub 8 times EBITDA, which historically, because they don't pay taxes, right? So they're usually up into double digits. So that gives you an indication of how inexpensive it is. And look, they're not going to get back to EPS levels pre-COVID just because of all the debt that they had to incur in the dilution. But EV to EBITDA, I think, is fair until they get to a more normalized leverage position.
And you're, when you walk through that valuation table, you're assuming just like that normalized level of EBITDA. There's no aggressiveness in your assumptions.
No, in fact, especially on the onboard side, Keith, where if you just look at leisure spend across the country, it gives you a real good feeling that people are going to continue to spend a lot of money on these cruise ships when they actually get on there. So I think that's where there's upside. So we're being uber conservative on the onboard side. But again, you just look at, resort ADRs up 30, 40%, and then people getting to these resorts, they're spending a ton of money. These are land-based type resorts, which compete with the cruise lines. So I think there's upside on our numbers, probably on the ticket side as well, just given where the trends are. But I would really point to that onboard where we're being particularly conservative.
Quick, just a housekeeping question, just going through my paces here. Who's Mickey Meyer? Owns 9% of the stock?
Mickey Arison, he's like, the guy, he used to be the CEO for years and years and years, and then he stepped down. He's like executive chairman. So he's, one of the original guys at one of the founders of Carnival Cruise Lines, and really steered the company for many years. So I think he's just executive chairman now.
It's interesting. Whenever you have an individual with that much stock and you have a super high short interest, in this case, I think it's 13 or 14%, you get in a tough spot if you're a hedge fund and this thing actually starts to get squeezed for real. So good contrarian idea there, man. Thank you.
Thank you.
All right. Howard, you have me wondering. Usually I can sort of somewhat read you, but I don't have any idea what you're going to go with here. So hit me.
I'm a little disappointed, Keith, but I'm going to use a word that it's in your vocabulary, and I'm going to reiterate a short on DoorDash.
Okay, DoorDash. Back to the DoorDash we go. So you like to short the profitless pump stocks. Okay, good.
A profitless TAM story, and they still use TAM in their vocabulary on their conference calls, which is remarkable. So the thesis you can see on slide 20 is a growing GMV, which it's growing only because they're expanding into more unprofitable convenience stores and grocery and whatnot. But this is the other piece of this is the race to the bottom. This is a business model where the pandemic has taught us that the industry is characterized by meager switching costs, no value differentiation among the competitors, and it's a commodity. Frankly, this business is a commodity, and their attempt to expand the pie, expand the growing GMV into delivering groceries and convenience items with the same characteristics suggest more losses are coming. And guess what you're going to see throughout this presentation? More losses are coming. And then lastly here, DoorDash has never operated in a recession. As a matter of fact, the industry grew up just after the last recession. So none of these companies have operated in a recession. So we don't know what's going to happen in a recession. But I have a slide that I think I can convince you that we know what's going to happen in a recession. But just to back up a second, on slide 21, you can see what's happened to the industry sales. 14% comp in January for Black Box, going to 6.8 in February. Traffic was 5, going to a flat 0.4 in February. But more importantly, what's happening in real time. So the high frequency weekly data that we're getting in March has shown a significant deceleration. Again, this is not Black Box, this is traffic. This is a different data source. So we can see our estimate for March for casual dining is down 4.2%, and it was up 5.6% in January. So you're seeing a significant slowdown. Now I will add, the industry slowed down, casual dining slowed from a -3.6 to a -5.2, and that's during the Silicon Valley blow up. So and you can see this more on the next slide, where the QSR post the Silicon Valley blow up. So this is basically through the 17th of March, went from a positive 3.5% to a negative 3.7%, and that's on the next slide, Eric, on slide 23. So a huge downshift in QSR, and this is the McDonald's, the Wendy's, and whatnot. And you can see for QSR, the traffic has slowed from 6.2% in January to now what we're estimating is 0.8%. So you're seeing a significant slowdown in DoorDash's most important business, and that's the restaurant industry. Now, Keith, I picked this because I thought you would appreciate how much it costs to get a McDonald's meal delivered to you. Now, this is 100 stores. I think it's 4 different McDonald's meals. So if you go to a McDonald's, you can spend $18.63 for a meal. Now, if you go on DoorDash and order those, right, it's $25. So one of the things the industry has learned in the last couple of years is to raise their menu prices, right, when you order on a DoorDash or an Uber Eats or a Grubhub. Bottom line here, as you can see on this slide, you pay $18, sales tax of $1.44. It'll cost you $20 in the restaurant. The same meal will cost you $25 plus a delivery fee, plus a service fee, plus a sales tax, other costs, tip, total $39. It'll cost you 100% more to get a McDonald's meal delivered to you on DoorDash, Uber Eats, or Grubhub.
Oh.
What's going to happen in a recession? Are people going to do this? You tell me, Keith. I just don't think that this is a good scenario for DoorDash. It's remarkable.
You get the fries are going to be they're going to be cold, and I can imagine that happening to you in Canada at this time, like in February or March. I mean, wow. Okay.
Never. Anyway, so it's really, and you can do this not just for McDonald's. I mean, this is across the board for any restaurant. The second, and we've already started to see the slowdown in sales. So since inflation started in mid-21, consumers have also reported less frequent off-premise orders. So the share of U.S. adults ordering takeout at least once a week declined 9 points between May of 21 and February of 2023. Now you can see at the sort of the right hand of that slide a little blip in January, right? That's because we saw this huge acceleration in sales in January, right? This is going to head back down as we hit over time. The next slide 26, is one of my favorite slides ever, frankly. They have a perfect track record since coming public of beating estimates on revenues, but missing earnings. And each sequential quarter, the losses get worse and worse. Like, you can't make this up. Like, this is really an extraordinary performance. Even better is on the next slide. So this is Dash's, I want to focus two things. The slide on the right, or the charts on the right, when they first came public, or let's call it through 2022, they lost 43 cents per order in Q1 of 2022. By Q4 of 2022, they were losing 87 cents on every order. Remarkable performance. Now, on the right-hand slide, I wanted you to notice the third quarter of 2022 was the first time since coming public that they saw a sequential deceleration in orders. Now, it picked up in the fourth quarter again because I showed you that restaurant industry sales accelerated into the fourth quarter, and that will happen into the first quarter too. Lastly, the next slide. Actually, I want to go to one more important slide. The last slide here, Keith, is stock-based comp. So they only give you, or they give estimates, adjusted estimates, or adjusted EBITDA estimates for stock-based comp. As of December this year, there's $2.8 billion of unrecognized stock comp. That means over the next 3 years, there's $1 billion of stock-based comp that has yet been unrecognized.
Wow. It brings us back
remarkable.
to
it's unremarkable.
Like of all the things that are inside the mother of all bubbles, when people talk about this, I mean, these are dwarfing .com stock-based comp schemes. I mean, it's unbelievable that these numbers. And this guy Tony Zhu, is it Zhu or you or he just sold like another $7 million, which is nothing amongst friends if you could sell a couple $100 million, but. You know, he just sold stock, like $7 million worth of stock, like in the 52 to 54 range. Stock's well above that.
Yeah, I mean, this thing could get cut in half. I mean, he's got $177 million of performance award that has yet to been recognized by the company. So he's doing just fine.
And the short interest is shockingly low. It's only 5% after everything that's happened to this company, profitlessness and otherwise. It's only 5% short interest. Isn't that interesting? Yeah. All right, just to give you the levels here, the DoorDash trend is 64. So the stock, you know, these are the setups we're looking for. Same thing as Lowe's. You know, the last price is 60. The trend is 64, so that's above the last price. And then your risk range wraps inside of the trend as well. So 57.06 to 61.28. So in other words, 61.28 is less than 64, which is the trend. So that looks it's a good setup. It's still got 24 billion in cap, Howard. So there you go. What's the pushback quickly here that you get from the long onlys? I'm assuming. I mean, I'm looking at the long onlys. It's like the real growthy types.
They believe the TAM.
That's all you got to say.
This
right?
is the next. This is the next Amazon.
Oh, Amazon. That's interesting. Okay. DoorDash is going to be the next Amazon with cold,
and they
soggy
even
fries for
compare
$39.
themselves to Amazon on their earnings calls. Frankly, like
Really?
they have, yeah, it's pretty extraordinary. They're big believers in their TAM and that this is a $1 trillion TAM that they're going after and delivering groceries and toothpaste and food. Just one last thing. So what they've stopped giving the analyst community is the performance of the restaurant business, right? So they don't break out separately how the restaurant industry is doing. They want you to look at the entire pie. And to me, that's a tell that, that they don't want you to know what's going on in the restaurant side of their business. They just ignore that, look at the whole thing, and this is what we're going after.
Well, that's the thing within the mother of all bubbles, believing in the TAM. I say this all the time, but just to say it again, and that's why bubbles exist and why people buy into bubbles and pay for profitlessness, is that any story, the bigger the story is, you can believe. It doesn't mean that it's actually true. How easy it is for you to believe it actually makes it the risk. So you have, that's what a bubble is. It's just, it's so complex to watch these things come undone. But good update on that. Thank you. All right, we got Freebird sitting right beside me.
All right, let's go.
Long or short?
It's a long.
That's good.
It's all right, though.
Your longs have been good.
Yeah,
lately.
I think that this is a bubble that burst, and we're betting on it maybe not necessarily inflating again, but just getting a little bit less worse. So let's get right into it. On Pinterest, on the long side.
Ooh, pins, former short.
Yeah, we were short it. Again, we got the bubble right, call right. Shorted it pretty much all the way down. So now we're going to go the other way because that's what we do. So in terms of the key thesis points, number one, continue to drive higher user engagement. 2, close the gap between inspiration, intent, and transaction. 3, international monetization opportunity. And then 4, which is very important, is the new cost discipline, committing to a preserving margin. And say an advertising recovery, that means stable to improving. I'll get more into that in a second here. But on point number 1 is really important in that the reasons that we were short the company in 21 going into 22 was because of the declining engagement trends that we saw post-COVID. We have since seen multiple quarters in a row of accelerating improvement in both time spent and user growth. Which is important because, as we all know, engagement leads monetization. They made significant investments in the UX, as well as investments in shopping and video content that's helping move the needle in a positive way. And ultimately, the bet here is that given the amount of time spent that they have relative to peers, it's still relatively small, that if they can make the correct investments to become more than just a life events platform, being weddings, buying a house, and those types of things, then it's possible that they can grow their time spent 20-30% from where it is today, which again opens up monetization opportunity on the ad side because you have improved efficiency. And on how do they get there, it really comes down to kind of closing the gap between inspiration, intent, and transaction. One of our criticisms of the company back in 21 is that they had this great story to talk about TAM stories, Keith, and bubbles, right? It was all about Pinterest being the next shopping platform, right? It was going to be the shopping catalog of the world, the next scalable e-commerce platform, right?
Gotta believe.
But the reality is that there was a lot of issues with intent, right? So it has while they have great signal into the very early stages of a user's shopping journey, right? You're not necessarily, and discovering content, you're not necessarily buying on platform and actually transacting. And so while they have great early signal, the bottom of the funnel has always struggled. And that's really how you drive advertiser return on ad spend, and that's how you really drive growth. And so with the new management team that's come on, the CEO's former Google, I think they're making the right investments, especially as it relates to the shopping conversions API, to really demonstrate that they're adding more value to advertisers, which they're a very, very small percentage of total budgets here, right? And so just small, given how large the market is, small improvements, basis points matter. And so I think that's where they are coming out of an investment cycle. Meanwhile, on the international monetization side, they still are largely under-monetized relative to peers. They're still, not only did they just first really made their big international push in 2019, but there's also some low-hanging fruit that they can pick off in terms of leveraging third-party sales in local developing markets to improve ARPU. So I think that's an interesting potential upside driver. Again, when we look at their international revenue growth rate relative to peers, because they are underpenetrated, they're still growing pretty quickly despite the overall slowdown in the advertising market that we've seen. In terms of the cost discipline and advertising recovery, we have seen stability in the ad market. Part of this, the positive thesis here is that management's already gone through kind of the negative surprise factor here. They've reestablished their cost structure. They've had layoffs. They just actually announced another round. They're rationalizing the real estate footprint. And so to the extent that, revenue growth is stabilizing, it doesn't have to get significantly better here, but as long as it's stabilizing and they have the cost structure under control, right, and combined with the activist involvement, the investments that they're making, the very company-specific factors that I think are resulting in their ability to take market share within their current large advertiser base, which are doing much better than smaller advertisers. You put all those things together, and I think that you have a stock where a company where the fundamentals are going to continue to outperform the broader ad tech space. And then, at least in terms of where my downside is, gives me a margin of safety on the downside with the potential for asymmetric upside. If over a 6 to 12 month duration here, we do see reacceleration in the advertising market, which would be, largely a condition of us exiting Quad 4 at some point, over that period. Not saying that we will or we are. I'll leave that to Keith and the macro team to guide me on that one, but that's kind of the thinking here. And so as long as I'm being covered on the downside in terms of the cost structure, right, I feel comfortable with the valuation and the comp setup where I can ride this out, waiting for potential positive turn. In terms of just the history, this on the next slide, the background. I mean, this is a bubble chart, right? This looks like every single bubble chart that you've seen, right? Like the huge influx into the pandemic, then and by the way, we shorted it in the middle of 21 and pounded it pretty much all the way through the spring of 22. But in terms of like the big key factors here, auto bidding rollout in 2020 was incredibly accretive. They're still fairly early on in terms of their investment in the ad tech. There was some, speculation that there was a strategic takeout with PayPal, Microsoft. We faded that. But really now it's kind of a new story with a new management team. And again, you have an activist investor in there that I think provides some level of support. The next couple of slides here don't really have to go into too much detail. They just are the data that supports the mobile time spent increase. And in terms of the valuation dynamics, this is a business that actually has free cash flow. There's a lot of stock-based comp, but this is not a Snapchat. And so I do think that also provides cover here too, a little bit of more downside protection in this type of environment where your downside is about $20 on a fundamental basis with upside on a base case of 35. I'd kind of ignore that 142. That's just a sensitivity table. We don't need to get there at this moment, but that's kind of where we are. And leave it at that. How about that?
Right on this. Wow.
Boom. There we go.
Boom. This, for those of you that still think that these other things aren't bubbles, it went from 91 to 17. So the downside is it goes back to 17, and that they changed the management back to the old management, whatever.
Something.
But this is what happens in bubbles. I mean, people should have a fine appreciation for that. By the way, this thing, I've been waiting and watching for this, finally just went to bullish trend, and it does take some time. Trend is $25.15. Risk range is 26.02 to 29.01. So that's good because it's basically the opposite of DoorDash, where your trend level is below the low end of the risk range. In other words, the low end of the worst you can do on my price target is 26.02.
Got it.
Right? So that's, and these things change. Please don't use some static thing. You're not watching Motley Tool or Chrome Dome Kramer. This is like every day the math changes on my front, and his math changes less so on the fundamental front, but there's that. Elliott, 4% now. Are they still in it?
Yep.
And you have some dude named Flashback Von something in there?
I have to check that one. Yeah.
3.5%. But the shareholder list is turned.
Yeah, absolutely.
The insider sales have stopped. There are a lot of things that have changed at this. I mean, I'm well aware of it because you were so bearish.
Oh yeah, I
on it
mean,
for so
going
long.
into 22, I mean, people thought that this was going to be a strategic takeout. Meanwhile, every single insider is just dumping stock left and right. I mean, you don't necessarily do that if you think that you're going to.
Right.
Yeah. I mean, so.
And the Elliott case, is there anything there? That,
Yeah, I
that
mean,
they
look-
haven't done or that they should do?
No, I mean, I think that the new CEO. I mean, I was never positive on the CEO or the CFO. That they were always an issue, and first thing they did is get rid of them. So that's positive. I think the CEO has the right chops, and they're executing. They're saying all the right things. They have the right strategy in place, right? That's the most important part, right? They're doing all the right things from an investment standpoint, from a user base and an ad tech side that that should help them continue to take share and generate and capture more share of incremental ad dollars if and when we ever get out on the other side of this, right? And I think that is the really interesting opportunity here, where if you can have a little bit of a longer duration, that is your kind of upside value capture. But yeah, I mean, cost savings, I think strategic alternatives, the typical activist playbook, like they're not going to lose money on this, and they're going to figure out a way to get paid. It's that kind of simple. So I'm
What's
willing
the
to bet
most ardent bear who's still in it? Because again, you've made friends with a lot of bears in this name. What is the most ardent bear staying with on the bear side?
Yeah, I mean, I think it's probably kind of the end market exposure, still kind of geared towards e-commerce companies. Lack of scale is an issue, right? Largely females, user base, the inability to kind of grow their users. That's always been a problem. Like, it's never going to become the next, I don't think it's going to become the next Meta, but I don't think it needs to, right? So I think in terms of the scalability of its user base and its ability to expand to other verticals is probably the biggest point of pushback. But again, like, everything has a price, and so I don't think that's the case. Like, it's a good demo for shopping. Lots of it, they've been growing their time spent. I mean, 30%. It's a big deal compared to where they were. They're growing faster than TikTok now.
I mean, as a bull, I'd be happy if this went from 19 billion in cap to 25. I mean,
take what you can get.
That take it.
Yeah.
I'll take it. It's hard for me to like.
But
if it says bullish trend,
I know. That's why I came in. I kind of had a sense. I was like, yeah, I think this is probably signaling good. I'll go with this one.
Yeah, don't you better not be logging into my.
Oh, I'm not.
All
No.
right.
I just can read your mind.
I like it. The one and only Freebird. All right. Tom Tobin, how proud are you of this guy, of that guy, man? He's like, he's now, well, you do it too, but I mean, maybe you taught him how to do it. You try to front run me all the time.
Uh, yeah, I mean, I've been at that for 15 years now, trying to figure it out. I mean, Bollinger Bands was the beginning, but yeah, no, he's surpassed me by a long shot. So good on him. I so I'm gonna pitch you UHS. Um, at this point in time, basically the background here is that there's two businesses here. One is acute care, general medical acute care hospitals, and then behavioral health, inpatient psych. The thing about it on slide 46 is it sits well within the quad factor um, setup. So we've run this back test against all quad fours, and then instead of looking at UHS specifically, its own history, we looked at the history of those factors, and it's right up on the line on screening long in terms of the batting average, the upper quartile batting average on a weekly basis, for those factors. And if you look at where it's been and where it's going to and where it's coming from in terms of EV to sales, it's at the lower end. It sort of went through COVID very, in a bad state with labor costs. Volume was, severely impacted by COVID. Staffing, just the whole thing was very, very hard to run a hospital during this period. The multiple had recovered, as the business recovered, but has since come down since the Q4 print. Short interest is pretty low, which is a good sign, and the analysts kind of like it, but not really. In terms of the estimates and slope, that's what's getting interesting, and that's one of the things that's screening positive here, is that the slope and acceleration of that revenue line is starting to pick up. You saw the big acceleration off the lows sort of in the second half of last year, but it's now just breaking back to above positive on a trailing 3-year basis. One of the things I like about that slope is on the next slide, just how much pent-up demand is sitting in there. This is aggregate weekly hours. If you summed the total versus what actually happened versus trend, you basically have this huge wall of demand that's been sitting in the backdrop. Whether or not people are delayed care and are sicker or something else, or actually sicker. One of the labor piece on general medical and surgical hospitals, the macro trends here are very good. The wages are starting to slow on the next slide, Eric. In terms of the lower right hand corner, aggregate demand is accelerating, so that's good for their inpatient hospital. And on the psych, that's even better. And I just want to point you on the next slide, the lower right, if you look at the wage growth on the next slide, Eric, the wage growth is now in decline. So that's very good for a company that makes up most of its cost within the labor side. If you compare some of those trends to what UHS reports on the next slide, so salaries per patient day in the psych hospitals versus that wage rate that I just showed you, salaries, and then on the year-over-year basis, it's a pretty tight fit. So I'm going to bet that's going to continue as long as the healthcare macro data continues. In other data, we can see on the HHS data that comes out weekly. We just updated this for this morning. This non-COVID and COVID volume is breaking out, I think. So up, 7% on a year-over-year is a big number, and it's recovering. And I think there's more to come. So we'll just monitor this on a weekly basis. I'll keep telling you to be buying it as that continues. In terms of the inpatient admissions against that data, you can see that on the next slide. Again, as long as that first chart is working the right way, we're pretty confident that inpatient admissions and surgeries and everything else is working. What's it all worth? On slide 55, basically, if you look at that lower bottom row, 75% behavioral occupancy, dropped all the way to 70. I think it goes back to 75. I think I get some margin improvement. I think I get upside to the top line. It's basically a thesis of 1,000 positives. There's no one thing, but they all work together. I think the stock could get, it's a 30% plus, but if I really mess around with it for the 2024 number, I can make it a double. That's on slide 56. This is kind of the sensitivity table at the lower end of what I'm thinking, and that's it.
Yeah, this is really interesting. It's like you go from Friedman saying, "Yeah, it's small. It's 19 billion in cap, like for Pinterest," and then I look up UHS and it's 9.
Yeah.
But it's the market share, the position obviously is significant. When you have, first of all, I'll just give you the setup. This is an interesting setup because it's not there yet, and they just had an issue in the quarter that I want to ask you about. But so the stock's at 124, trend is at 128. So 128 means you're below trend. The risk range is 118 to 120, 118 to 127. So the top end of the range is just inside of trend by a point. Now, it's also signaling higher lows. So that typically can work. In other words, like someone like me, which and this is very typical of our relationship working together, is that you're trying to get a bottoming process right. My signal doesn't like it yet, but then if you're right, it likes it all at once, and then like in a day, it'll be at 128 or 129 and climbing, and I'll be like, that's a bullish trend, and I'll have missed the first part of the move. How does that fit, like at least my math and my setup quantitatively fit with like what they just said on the most recent call,
Right.
which, correct me if I'm wrong, but it was not impressive.
It was not good. It wasn't good. I mean, they got some of what I wanted to see right, and then they got some of the stuff wrong. On the other operating expenses, there's some stuff in there that, physician recruiting. So you hire in these docs to essentially admit patients to your building. So it's an arm's length relationship. You got to recruit docs to come work in your area, and there's an expense for that. They put in some of the contract expense in that other, and it went up a lot, right? I think that's going to abate. I also was saying into that print, hey, I think there's going to be upside at the SG&A line, and there was. It's not as much, and the bigger problem was that they didn't guide to it. So both ACHC, their peer, and UHS talked about or guided to continued labor cost issues in 2023. I still see, occupancy going up and to the right, and I see costs coming down sequentially to the right. So I think those two things will eventually get me my labor, my labor leverage and my upside of the top line. They did guide the top line higher. So net, a delay in the thesis more than, if I had disconfirming evidence on the healthcare macro side, I would have bailed, but I don't. And so that's the base. That's the big thing.
Well, it's
and
also the difference between healthcare macro data and U.S. consumer macro data. They're going the opposite way. So I mean, that's what makes it interesting.
Yeah, and the other issues, you've got this kind of handoff from, the founding, the founding father handing it off to his kid. There's some critique around Mark Miller in terms of as an operator. I've talked to some of the operators, like the formers in the psych hospital and the acute care, and there's always hair. You always hear about people who don't like their job after they've left. Some of the hair here is a little more concerning than average, but at the same time, I like these stories where you get, I would never give a lot of management teams, they take a lot more credit than they deserve, and at the same time, people punish people that don't perform in a bad market, in a bad industry. This is an industry that's improving. Everybody's going to look like a genius. That's sort of my 2 cents there.
Yeah, that's what the cycle can do for you, both good and bad. Make you look like a genius and an idiot. All right, good, thank you. Last one, we got Daniel Biolsi, who's coming in hot here, sitting in the flesh. And like Howard, because you guys threw me a lot of new tickers.
Yep.
So I don't know which one you're going to like or not like.
All right, so here we go. And I'm back, so it must be my last one worked okay. So we'll go again.
What was your last one?
Lancaster Colony.
Oh man, yeah, the sauces, the sauce. I like the sauce.
So I'm bringing Hershey, ticker HSY,
okay,
here for you, Keith. It's
Good.
Sweet and salty. So Hershey has brands with pricing power, right? And that's the most important thing right now. Hershey brands have demonstrated best-in-class pricing power during a period of once-in-a-generation inflationary pressure. In Q4, price contributed 8.5 percentage points of growth, while volume grew 2.2%, among the best overall elasticities in CPG. Last year was held back by capacity constraints. They just didn't have enough capacity, so that's a positive going forward. So additional capacity in 2023 provides volume growth visibility. Gross margins inflected in Q3, and they just expanded in Q4, right? So we're just in this pod 2 acceleration. Margin recovery in the coming quarters provides visibility into growth exceeding long-term targets in 2023. The accelerated entry into the snack category adds a new growth pillar. So if you haven't been paying attention to what they've been doing, the salty part of the growth story is just starting. Hershey has one of the best secular growth prospects in food. The company has improved its M&A integration process, giving it the confidence to seek more targets. Hershey has made a series of acquisitions in the category to grow its platform. Looking to the long term, the snack category's organic growth will be a manageable 10 basis point headwind to overall margins. That's the dilutive impact from the mix to the overall mix. This year will be another year of sales and EPS growth above the long-term targets of 2 to 4% on the top line and 6 to 8% on the bottom line. Hershey will be differentiated among its CPG peers by having gross margin and EBITDA margin expansion and at the same time having volume growth. I expect the margin recovery in Quad 4 to continue to be drivers of share price outperformance over a trade and trend duration. And over the next year, I see 15 to 20% upside, which could be supplemented, boosted by another acquisition if they do that. On slide 60, you can see the quads for Hershey. It is a Quad 4 relative outperformer. The style factors in its favor include low beta, dividend yield, quality, and defensive. It's got all the things you like in Quad 4. On 61, you can have a little brief look at the recent history. And what I'd point out here is if you haven't been paying attention, you see these acquisitions in the salty category. They bought Skinny Pop, Pirate's Booty, and just recently they added Dots. On 62, I just want to spend a little time on this salty growth pillar that they're doing. The recent acquisitions are accelerating the expansion into this category. And so I'm just going to read 2 quotes from the company just to give you an idea of how important this is to them. We have ambitions to become a snacking powerhouse. The Skinny Pop acquisition was a major success. It has provided a growth template for other brands. The success of Skinny Pop and Pirate's Booty has helped identify and understand what size a brand needs to be for us to bring our capabilities of scale in the best way. And then Dots sales have actually doubled with Hershey's distribution, reaching a high double-digit percentage share of the pretzel category. So I think management is just starting to get confidence in what they need to do for their acquisitions, and that's going to give them sort of this accelerated pipeline of acquisitions because they know how to integrate, they know what works for them, and then once they plug them into their system, the growth accelerates. On slide 63, we have, this is a little bit of the snacking focus that the company has. Management has expressed this desire to expand further in salty snacks. Hershey commands nearly half the chocolate category share at 47%, and it continues to expand. The company has made acquisitions into salty snacks a higher strategic focus. And there are a number of brands that could be on Hershey's target list. Hershey appears to be looking to grow in snacks that are less indulgent and perceived as better for you alternatives. The other areas of salty snacks are chips, nuts, seeds, puffed cheese, mixed offerings, crackers. There's a lot of space for them to continue to grow, and when you're in the Hershey system, you automatically get shelf space. So what Hershey said was, we're not great at a super small new startup. We need a brand to have a little bit of traction in order to scale up and for us to be able to engage with them in a way that's really meaningful and bring our proposition to the table. So the margin story is what's been holding back the company recently with all the CPG companies. So 2 soft commodity prices that I'm going to highlight here have been going the wrong way, and that's cocoa on one slide, and others are going the right way, like dairy. But in slide 65, you can see sugar. Sugar has also been increasing recently, but those could be offset by other cost disinflation. So on the PPI here on slide 66, you can see producer prices appear to be topping, but the raw commodity increase, what that means is everyone's going to need more pricing, and Hershey can do that. One of the costs going the good way for them as a tailwind is trucking on slide 67. These contract rates have decreased 27% year over year, and diesel is down 17%. Those are all margin tailwinds. Hershey is also able to pass on prices. Because the category has a very low private label share, it's only less than 3% of the US chocolate market is private label. Chocolate is a comfort food. 70% of consumers report eating it in the past week, and then more than any other sweet, it is, it gives you cravings. And then the margin comparisons on 69, Hershey enjoys the highest gross margins and operating margins in the food category. Gross margins inflected in Q3 and expanded for the first time in Q4, and additional price is being passed through in 2023. And then finally, on the valuation slide, we have top-line visibility from price increases. We have capacity increase. That means volume growth combined with pricing power. We have expanding margins from price increases. We have the catch-up to inflationary pressures, disinflating costs in other areas, and we have the right quadrant. So it is a premium, but you have visible organic growth drivers and best-in-class margins.
Nice. Nice job. This thing is absolutely ripping today. And for the record, he's been bullish on it. If you're a subscriber to the call, you would have heard that. It's on my signal strength list. You would have seen it there as well. But today on No News, this is a pretty good example of what happens in Quad 4. All of a sudden people are like, oh, I'm too long of the Titanic. They're along the magma.
Right.
And over here, they're like, oh, well, I got to find something else with like 50 billion in cap. And there it is. Voila, now Hershey has 50 billion in cap. I actually have it, so on that, Pepsi has 250 billion in cap.
Yes.
And this whole narrative now, it's not a narrative. I mean, all three things, Skinny Pop, Pirate's Booty, and Dots, I mean, very popular in my house of 4 kids. You know?
Okay.
My kids are addicted to
It's
these.
because you have a little more better for you.
Yeah, well,
opposed to,
I
like,
don't know. They
Doritos.
just like that stuff. But I mean, it's like how much, because when you see a stock break out to new highs, like today's an all-time high for Hershey. A lot of people, especially the intellectual types, I know some of you are out there, they only like to buy the cheap stuff, the stuff that could get cut in half again. It's a real fascinating thing, but momentum is what the machine really likes. And you know, when people see that, they're like, you know, I just can't buy that. I missed it. Intellectually, I just, okay. But what is it about CPG, if they're legit about this, you know, acquisition story, that, you know, Pepsi's got 5 times the market cap?
Well, so Pepsi in snacks is the 800-pound gorilla, right?
Right.
They have the Frito-Lay is the dominant one, and they've been passing on prices. But you know, it does leave room for some other alternatives, right? The grocery stores, if you think the mass stores, they need something else, right? You can't just let Pepsi run your snack category because you need to have something to price off against it. So I think that opens up even more someone like Hershey, who's already in there for the snacks, and then you can have the same driver, you know, distribute the salty snacks. So it opens up distribution growth. And the more they acquire these other brands and these other categories like nuts, like there's no reason why nuts couldn't be in there, right? Because that's a healthier alternative to snacks, that they're just going to get the distribution wins very easily compared to another company if they were going to do that. So if you're selling to them, you know you can still grow with Hershey, right? You're going to grow even faster if you sell your nut brand to them, right? Or your puff cheese brand to them. You're going to achieve better things with them. You don't have to sell out completely, right? You can
You can ride it.
Yep.
I mean, those economics. There are a lot of founders who seek distribution. I mean, we have a lot of, and by the way, if you know any good content creators, we're in the business here of partnering with them or buying them, because we have distribution. We have our own TV channel. I know how to think about that. But just quickly, just to hit on the things that I want to hit on from a quantitative perspective. So stocks at 253, trends at 231, so well above trend now. The low end of the range is 242, top end of the range is 259. So again, that setup that I like, where the low end of the range is, you know, it's $11 above trend. So this is what feeds the beast. You know, when you look at, if you guys go to slide 8, Quad 4 consumer staples, most recently we had a breakout signal. This is perpetuating that breakout signal because it's a big component of the sector factor exposure. So, you know, it's got, like you said, it's got the right quad, it's got the right sector, and now it's got the momentum. So, you know, here you go. Do you have any hedge fund? There's only 2% short interest. So I assume, well, if it is a popular hedge fund short, it's certainly not in the short interest. But I assume that anyone who's been fighting you on this has a headache today?
I don't think there's that much short interest. I think what's going to happen is a lot of people within CPG are going to be rotating out of some other, you know, consumer staples into this one because they have volume growth, and that is the big concern in 2023, right? You've had so much price. People didn't care about the volume growth last year, but now going forward they do because we're anniversarying all that price, and we're going to have larger and larger volume decreases. But because Hershey was short capacity last year and they've added capacity this year, you have volume growth. So you're not going to, they check that box when so many of my other companies don't. So I think within staples, you're going to see some rotation into Hershey.
You know what's interesting about that, and what I love about, you know, I love the game, obviously, but working on a team. I mean, I've been wondering, and I didn't need to know why, but all macro subscribers or people that listen to the show know, there was recently a breakout in cocoa.
Okay.
And I'm like, that's variant.
Yeah.
You know, the commodities index hitting new lows, ag's hitting new lows, and cocoa, NIB is the ETF for that, breaks out on accelerating volume. Well, guess who needs a lot of cocoa?
This company.
And so volume to the cocoa. Now I don't have to do any research. See how I don't have to go to the depths of the Yale Library and start to write a white paper on cocoa.
There we go.
It's good. We're good. You know, tying it all together. Thank you for joining us, and thanks to my analysts for bringing the heat. This is not an easy game. Not an easy game. Again, use your quantitative setup, use your quad setups, and find some good analysts who can help augment that. Thanks for joining the pitch.